Well, I'm joined now by the chief economist at Lloyds Bank Corporate Markets. Trevor Williams is also a member of the Institute for Economic Affairs Shadow Monetary Policy Committee, where he voted to keep rates on hold because of the weak economy and negative growth in money supply. Thank you so much for joining us, Trevor. How surprised were you that we finally got unanimity?
I'm not surprised at all, frankly. It would look very odd if Martin Wheel and Spencer Dale, chief economist at the bank, were continuing to vote for higher rates in the context of the international market movements that we've seen, which have all clearly been extremely negative.
Now, what does this do for the prospect of any rate rise in the future? Just how far does it push all of this back?
Well, I think it pushes it back into next year. Obviously, if one looks at market expectations, it's pushed it into 2013, and it's been there for a few months now. I have to say our view was that there was a possibility that it would be raised by the end of the year, on the basis that the second half of this year is probably not going to look as weak as some of the current indicators would suggest, and indeed as far as the markets are concerned, I think it may well turn out to be significantly stronger than is currently priced into the interest rate curve for the UK.
Look, what factors really need to change in the UK in order to change the stance of having everybody voting against any prospect of an interest rate rise?
Well, first of all, I think it will require stronger domestic growth. I think some of that will come through, by the way, but I'm not sure that it will be strong enough to lead to anyone in the committee voting for a rate hike over the course of the next 12 months. We've pushed our hike now from November to August of next year. And secondly, I think it would require perhaps signs that the markets don't longer believe that the Bank of England is correct in leaving their interest rates where it is, given how high UK inflation is. It's easy to forget that our inflation rate is actually 4.4% on the CPI basis, and it's been above target for nearly 2.5 years, and yet the central bank has done nothing. That's only because the financial markets believe that the bank is correct in doing so, on the basis that the inflation being generated by the domestic economy is very weak. And of course this is shown by the fact that wage inflation remains low. However, core inflation, excluding the effects of VAT and the effects of international changes in energy and food prices, are beginning to point higher as well.
Now, let's talk a little bit about the prospects for quantitative easing. Obviously, we only had one member voting for it, but interestingly, we were told that it was actively debated this time, and that's different, isn't it?
Well, I think, once again, given the fact that there is so much financial market turmoil, it's not surprising that the bank is considering using QE, and secondly, given where interest rates are, which is zero effectively, 0.5% is well below any effective interest rate in the UK, and therefore Bank of England interest rates will make no difference if they were to cut them to zero. So they have to consider a non-interest rate monetary loosening, and QE is one of the ways that they would do that. However, unfortunately, I don't know if it would work, because what it would do is to lower, of course, long-term interest rates. But given where long-term interest rates are, i.e. at around 2.5% for 10-year money at an historic low, then I don't know if QE would make much difference to that. The problem seems to be more like that households and businesses in the UK are refusing to spend. And in fact, low interest rates may well be a negative for those that are saving and are seeing no income. So I'm not sure that QE would work here, even if they were to embark on it.
Trevor Williams, thank you very much indeed for joining us.